the risk-free rate. So I was expanding it for you to understand more, to say a risk-free investment might be a government security whereby interest rates can vary. Sometimes it's going to be no interest, sometimes interest will be there based on the rate or on what you have at the rate. So that's the second one. Problems with applying the CAPM. The third one errors in the statistical analysis. Errors in the statistical analysis used to calculate the beta value. Errors in statistical analysis used to calculate the beta values. So beta may change over time. So it is difficult to do sometimes the calculation. I remember last meeting when we were calculating something to do with the same, we found out that the answer was not exactly the same. Okay. Those are some of the errors that are there for us. Okay. You can calculate, but sometimes you cannot reach the amount that is required. So it's difficult for CAPM to work well. The fourth one is the CAPM is also unable to focus accurately the returns for companies. CAPM is also unable to focus accurately the returns for companies with a low price or earnings. Good. Very good. Ndiri mu class ndikuimbire. Good. Undiimbire chama few minutes after 10. Good. So we're saying for the CAPM or CAPM is also unable to focus accurately the returns for the companies with a low price or low earnings. So it is difficult. That's why I say, CAPM works where you have got several portfolios and big amounts that you are making big profits. Again, maybe we should also, because we are only cost of capital, we are just continuing the same presentation. We are now supposed to look into the cost of debt. Because when we're talking about cost of capital, we're about debt and equity. So we were looking into equity, but now let's go to debt. So the cost of debt is the return on enterprise where it has to or must pay to its lenders. Debt, mind you, see bonus, and you are supposed to pay back. For irredeemable debt, this is the post tax interest as a percentage of the ex-interest market value of the bonds or preference shares. Mostly, when we are talking about, let's say, big debt, we are talking in connection of big interests that are concerned. So for redeemable debt, the cost is given by the internal rate of return of the cash flow involved. When we are talking about, let's say, big debt in connection of bonds and shares, we talk of we base on the return based on the cash flow itself. Okay. How are we this cash flow actually managed? For example, let me explain the cash flow partially of the university for you to understand better. In January, that's the first, let's say, month of the semester, isn't it? Yeah. So it means you learn up to the end of January. Okay? Or let me take this one that we are in. We started when? July. Is it? July. We started July, where everybody came to class and we finished the month fine. Okay? In February, did we finish, or when did we have, in August, when did we have our mid-semester? We had in August, isn't it? No. Come again? End August. Good. So it means the whole August we didn't learn, isn't it? I'm just giving you an idea how to explain when we're talking about cash flow. So it means, let's say, more money was used in buying of whatever you are doing, payment of the lecturer, because it was a full month. And yet August, part of it, you didn't learn, you came for exam. It means the cash flow went down. September, we have learned the whole month, is it? It means the cash flow is going to pick up more money. So this is what I want to explain to you to say. It will depend on the cash flow. When you have more money, maybe you are going to redeem more. It's a milk company. The cash flow that we have the whole of the year, which is the January to December. And then, according to the products that we had, it will depend on which we have sold at which time, because others go seasonal, is it? Yes. Mataya, pamela mabulidwa kwambiri mwina nthawi ya mvula. Panopo kumakhala si because nthawi ya mvula wakonda kusomali, mvula yanyamula misomali kuyakuwa chantani. Okay? Pamene nthawi ino ayi. So we can say in January we have sold so many tires and we have, let's say, more money in January. In January we had made about, let's say, 50 million. plus these others that we have sold. And then in February, yes, we also have the same, because in Italian gold, maybe we can have let's say 49 or 47. 47. Plus these others. Okay? Then when we go to June, July, we go down. So you agree to say, how are we going to redeem our debt? You say, the time we have more money, we have to be redeeming the debt more. When we do not have more money, we should redeem less. Because you know the period when you make more money and when you do not. This is what they are telling us, that when we are talking of cost of debt, sometimes companies use that to say, we should pay more when we have more time. I can give you an example also on what I found in the office. I found that tax was not being limited. Why? Because of the cash flow. So what we did was we had to pay the time when we had more money, and then do not pay when you don't have more money. So this is just a terminology that you as the asset and financial manager, you can advise management to say this is how we should be doing. So the cost of capital in connection of, let's say, capital, we can think about the cost of continuing to use the finance rather than redeem the security at their current market price. So we, as the finance or as the asset and finance financial managers, we should have those ideas in mind, that we should know how we should be redeeming our debt. Also, we have to know that when we have debt, we also have to pay interest. Is it? Ngongole ukajenga, umajenga umabweza ngongole, kwa maana umabweza cha interest. Yes? So all those are supposed to be programmed, that this is how we should be doing our repayments when we are doing the debt. If you assume that the cost of the additional capital would be equal to the cost of that already used in the company, then you are raising additional fixed capital as well as interest. Is it? Mufuna mukulise ngongole munatenga kama muluke poso yini. It means you are adding the capital as well as those who live the currency as well as the interest is very high. So we should also think about the risks that are there when we are talking about debt, because you can sometimes fail to repay or to redeem. So risks are there. Sometimes you can pay interest and not debt. Sometimes you can pay the capital and not the interest. So all those are some of the things that you are supposed to focus by making similar calculations for the company, for you to judge that the risk should be minimized. So we should look into the irredeemable debt capital. Irredeemable debt debt capital. So irredeemable debt capital paying interest is in perpetuity and having a current X-interest rate. What is perpetuity? Because it is similar considered. Zimafunika kuti inuyo ngatafosi zambiri izi muziziwe. So when we are talking about the perpetuity, we are talking about how you are supposed to give back the debt based on capital as well as interest. So when we are talking about perpetuity, it means we are talking about things like mugweza mpaka lipi. Okay? For example, you have the period where you are going to give back the loan that you have taken. So how are you going to be paying and up to when? That's the main thing that we want to talk about when we are talking about perpetuity. Usatopa kupeleka mgongoni hiyo or interest. Okay. So that's what it means. So we have got the formula that we are given in connection of irredeemable debt capital. We have this KD. KD is equal to I divided by people. Last time we talked about the PO, is it? What did you say PO is? The ordinary language. It's the same presentation that we did. Come again? Current market value. Okay. So we are saying irredeemable debt capital, which is KD, is equal to interest divided by current market value. Yvonne, Barbara. Irredeemable debt capital, we are saying, is equal to interest divided by current market value. Okay? So, they have given us an example that I don't think we should write it just an easy because the formula is very easy. Teacher, read.
What's your name?
Morning of us, or is after 4? So we are given an example that reads it's just a simple one, okay? LP company has issued bonds of $100 nominal value with an annual interest of 8% per year. Based on the nominal value, the current market price of the bond is $80. What is the cost of the bond? Okay. So that is irredeemable debt capital. Then they are saying KD, which is the redeemable cost capital, is equal to 8 divided by 80, which is 10%, which is very simple. So this is just a simple example when we are talking about irredeemable debt capital. Why should we talk about them or know about them? Because they are assets of the company. And not only that, they are the cost of capital. That's the other part of the cost of capital if we are talking of debt. So here the stress on bonds, the stress on shares, because as we already know that the CAPM is used in big companies, not in just small companies that we can maybe ever think about. So we have another one, which is the DH company has issued a bond of 100 nominal value with annual interest of 10% per year. Based on the nominal value, the current market price of the bond is 85. Required, what is the cost of the bond? So it's just the same calculation as we did, and then we just wanted to appreciate and know how we do it. So we have to know again a bit about redeemable debt capital. Those were irredeemable, but these are redeemable debt capital. redeemable debt capital, always when we are calculating, we ignore